What's your approach to timing Bitcoin? How do you time bottoms and tops? Do you do this based on gut feeling? Do you do this based on news? Do you do this based on whatever your other YouTubers are saying? How are you actually timing the bottoms and the tops? Do you have actually an objective approach? Or are you just taking gut feeling? Because if you're simply just basing everything on gut feeling, probably you're not going to outperform, right? The people that do objectively good decisions that are measurable tend to be the ones that outperform. And so I use pretty much a static set of data points, mainly on-chain data points. And the question is always, what are we going to do when we think prices are low? What are we going to do when prices are high? But more importantly, what are we doing when prices are just in the middle, when we are not super depressed or super hyped up in the market? The way how I define super depressed is when the market in aggregate is in losses. So my favorite value to look at to see where Bitcoin price is cheap versus expensive is the realized price. So I recommend you very strongly, in case you haven't looked at it yet, to search out the realized price. So simply Google this, realized price Bitcoin. You will get a chart that shows where we are currently at roughly 30K, a bit over 30K in Bitcoin. That's the average cost basis of the market. So the realized price looks at all of the Bitcoin that has ever moved, looks at what specific price did the Bitcoin move at that point in time. And then we see, okay, on average, the market got that certain price. And currently, that's a bit over 30K. If the current price is above the realized price, then the market in aggregate is in profit, right? The market in aggregate sees a green number in their portfolio. If the price currently is below the realized price, then the market in aggregate is in losses. And the market in aggregate is in losses, the market tends to sell less, right? So the sell pressure tends to go down. It makes sense to buy over there because when there's less sell pressure, there's more likelihood of the price rising at some point. And vice versa. If the market is currently very much in profit, then at some point people might consider taking profit and maybe rebalancing their portfolios. So I do believe that long term, the Bitcoin price is always going to hover around the realized price. And if the price is currently below the realized price, that's for me a bottom signal. So this is how I pick my personal bottoms. There's many ways to spot the bottom, right? Some people use logarithmic regression charts. Other people look at how many transactions are currently been done. Other people look at the active number of wallets. Is there currently a lot of active wallets or not so many active wallets? There's all kinds of different ways to spot it. You could also look at social metrics, how many people are currently looking at crypto content. When that's very low, attention is low, thus the price might be low. Many ways to do this. I personally prefer the realized price. So that's how I spot the bottom. Feel free to check it out. Feel free to copy me. Feel free to get your own approaches, whatever works best for you. But I do believe it's very important to have some kind of an objective measure. Do something, right? Use some kind of model or combination of models that then determines whether or not you should get very heavily into Bitcoin or if it makes sense to rather sell some. Now, how do I spot tops? For tops, I look at what other people doing that normally do not sell. So there's another on-chain metric called the value days destroyed. And the value days destroyed looks at all Bitcoin and checks for how long have these Bitcoin been dormant. So when the Bitcoin hasn't moved for 5 years, for example, and then you would suddenly move that one Bitcoin, then you're destroying 5 value years. So a long-term holder suddenly sold. If it's a whale that maybe held it only for 1 year, a whale, right? Let's say he has 5 Bitcoin and he sells after 1 year, he's also destroying 5 value years. So the bigger a wallet is and the longer that wallet had been dormant, the more value days they destroy. And when we look at this over time, we see very nice waves and we see how those waves coincide with price tops. So whenever the people that tend to actually not sell, whenever the whales that tend to simply just hold over time, when they suddenly start moving their Bitcoin, that's the time when I want to move my Bitcoin as well, right? When the smart heavyweights are selling, that's when I want to sell as well. So I don't have to be a genius in all of this. I simply just look at the other geniuses, then I simply copy trade them, so to speak. So I look at the value days destroyed, the VDD metric. Feel free to look that up as well, right? Simply just search Google, value days destroyed Bitcoin. You will get a chart. Simply bookmark this. And this is how I personally time the tops. This is how I sold 1 day after the recent all-time high. So it's no real magic, right? You just have to figure out what kind of things to look at. Just going by gut feeling is probably not the best approach. The best approach, in my opinion, is to use as much data as possible, especially use the data that worked well in the past. Now, those are the extreme scenarios, right? We want to be buying when the market is super depressed. and we want to be selling when the long-term holders are selling as well. So we do have the extremes, but what do we do most of the time, right? When the price is neither depressed nor it's super hyped. What are we doing actually in between? Like right now, right? We are not below the realized price and we don't have a massive spike in the value that is destroyed. What are we doing now? I think at those points in time, it makes sense to follow your general portfolio allocation strategy. So don't just own Bitcoin, right? It makes sense to own all kinds of assets for various reasons, to decrease overall portfolio volatility, but also to be able to buy bottoms, right? When you've got some gold, you've got some long-term bonds, you've got some stocks, and suddenly Bitcoin crashes 50%, you've got something to buy the dip with. If you only buy the dip with your regular income, you don't really take advantage of the dip, right? If you've already got a bit of wealth. So you do want to have all these other asset classes that you can take advantage of dips in any asset class, right? Bitcoin can crash, but other asset classes can crash as well. If you're well diversified, you've always got something that you can sell in order to buy the dip in whatever is currently depressed.
Here's the problem with crypto YouTube. People promoting becoming degen or buying 100x coins. That's what gives clicks, but that's not what's going to bring you forward. I refuse to take money from centralized exchanges. I refuse to take money from crypto projects. I refuse to pump and dump a coin and filling up my pockets in the background. I don't do any of this. Instead, I share my knowledge in the form of tutorials in the premium membership. So that's content that won't do well on YouTube, but that builds up skill over time. You can also directly contact me over there. You can directly pick my brain. Feel free to check it out. TheBitcoinStrategy.com is the link.
And so again, what should we do in case we're neither super depressed nor super hyped? I think the best is to follow the strategy of your allocation. The best is to see what is your target allocation for Bitcoin. So think about how much allocation do you actually want to have long term. Let's say the market is super neutral for all asset classes, right? Property is not expensive, not cheap. Gold is not expensive, not cheap. Same for stocks, same for Bitcoin, same for everything else. They're all super neutral. Nothing is super hype, nothing is super cheap. In that scenario, what kind of allocation do you actually want to have for all asset classes? Do you want to be 30% in property and 10% in Bitcoin? Do you want to be 40% in Bitcoin, 40% in tech stocks, and only very little in gold and in property? What's actually your desired allocation given your time horizon, given the kind of volatility that you can digest, given your wealth relative to your income, given your wealth relative to your age, how much longer will you have that regular income? Those kind of considerations make sense, right? Are you okay with your overall wealth dropping by 50%? Or do you rather just want to drop it by, say, 10 or 20% because you're close to retirement or because you've already got 10 years of income in wealth, right? So those kinds of considerations make sense. Once you've got the target allocation for all of those different asset classes, and obviously different asset classes have different volatility, right? So you don't want to go super heavily on Bitcoin and on the NASDAQ if you want to be rather risk off, right? So you want to think about the target allocations. Once you've got those target allocations, you then have to paint a picture of where each of those asset classes are. And if they're all neutral, you just keep that allocation. And if you're currently, say, under-allocated in Bitcoin, because Bitcoin dropped a little bit, simply continue dollar cost averaging into it with your regular cash flow. If you're currently slightly over-allocated, a slight over-allocation is probably fine. But if you get even more over-allocated, maybe you have to rebalance some, right? And you have to sell some Bitcoin, put this into the other asset classes. So you want to use your regular cash flow to rebalance yourself out in this neutral portfolio. And once one of the asset classes is not neutral anymore, right? Once one of those asset classes is very high or very low, you rebalance. Now, you don't necessarily want to keep the neutral allocation always. So let's say Bitcoin suddenly crashes. Let's say it crashes tomorrow to $20,000. Super unlikely, but let's say it happens because of some kind of external event that's actually not really related to Bitcoin, and you think overall Bitcoin will continue to thrive in the next 10 years, you're okay to pick up those 20K Bitcoin because, I don't know, Mt. Gox holders suddenly sold, right? That Mt. Gox selling has stopped now. There's no more Mt. Gox selling to be done. So we are now at 20K and you want to buy long term. In these kinds of cases, right, when Bitcoin is extremely depressed, you don't just want to be, let's say your neutral allocation to Bitcoin is 10%. You don't just want to stock up your Bitcoin allocation to 10% because that's then your neutral portfolio. you want to go over allocated on the very depressed assets. So you want to, at that point in time, maybe have, instead of 10%, 20% allocation to Bitcoin. So you over allocate when the price is below what it should normally be, according to whatever you think is a fair value. So when we are in a hyped market, everybody talks about NFTs and about meme coins, and the price went up by 50% in the last month. When we are in a hyped market, you want to be below your target allocation, below the 10% in that example. You might only want to have 5% in Bitcoin. And when we have just crashed, you want to be potentially 20% with your portfolio in Bitcoin. And then, of course, over time, you have to rebalance as we approach the fair equilibrium price for all of those different assets. It's always the hardest part in all of this is obviously, first of all, figuring out what are your target allocations, but secondly, also figuring out where are we, relatively speaking, with those different asset classes. And for Bitcoin, I've already told you how I do this, right? I do this with the realized price. For stocks, it's another topic. For property, it's another topic. For gold as well. For gold, you can also see this relative to the silver price. So there's many different approaches to all of those different asset classes. Bitcoin is the most volatile of the bunch, so it's the most important to get right. But it's always good to also have somewhat of a feeling where, for example, now the property market might be, right? For the property market, one could look at, for example, what is the price now relative to the interest rate developments, relative to the number of transactions that are being done, relative to the inventory that's currently available, relative to house affordability, right? Maybe the median income relative to the median house. Having a look at that might also make sense. So many different metrics. Simply pick the metric that makes most sense to you, that you believe makes more sense. And of course, for the stock market, we've got very similar things, right? We've got the S&P 500's PE ratio, right? What's the current price to earnings ratio for all of the S&P 500? We've got the market cap of the stock index versus the GDP of the country. We've got all kinds of things. I hope this video inspires a little bit to look into those kinds of data points and to get into investing with a bit more of a balance, with a bit more of a technical approach. You want to manage your volatility, especially if you don't just have a few months saved up, but you are already at 3, 4, 5 years of wealth relative to your income. You want to make sure that you don't just drop by 70% because you put it all on Bitcoin. You want to make sure that you've got a nicely diversified portfolio, that you take advantage of the dips, that you over allocate during those dips, and that you take massive profit whenever we are super hyped, and that you have a pretty nicely balanced out portfolio in all of those remaining days, right? You want to continue to dollar cost average into the asset that tends to be maybe slightly depressed, and you want to potentially take profit in the hyped assets. Feel free to subscribe in case it's your first time here. Feel free to also give this a like. It helps the channel grow. Feel free to also join our Telegram channel. There is a free Telegram channel. The link is down below. Looking very much forward to seeing you over there as well. Cheers.